Hey guys, Alex Ruiz here again, and this is the third video on capital gains tax. This specific video is for clients who do not live in the properties or for non-owner occupied investment properties. So the client already lives in another place. They have a house, maybe it's a 2, 3, 4 family, or it's a commercial property or mixed use, whatever it is. The capital gains tax is pretty simple there. You're going to do the same thing that we've done in the other videos where you figure out what the basis is. Basis is the original purchase price plus closing costs plus capital improvements on the property. Don't worry at this point whether or not they have any receipts to prove that they actually have the capital improvements in the property. At this point, just figure out what that is, and that'll give you your adjusted basis after you deduct whatever depreciation was taken on the tax returns. Okay, so it's purchase price, capital improvements, closing costs from the original purchase, along with the deduction for any type of accumulated depreciation. Okay, then you figure out what the sale price is going to be on that property, and it's sales price minus commissions paid to the real estate minus closing costs or transfer taxes. And then that'll give you your adjusted sales price. The difference between those two is subject to capital gains tax. Now, how much do we have to pay? Well, it depends. It really depends on whether they're filing a single return, a married filing joint return. The exclusion amounts are a little bit different for each type. But basically, the tax rate is anywhere between 10, 15, and 20%. In addition, that's just federal. So you still have to pay state taxes also on that. And the state tax, and if there's a city tax, like here in New York City, it's actually taxed at the normal income tax rate that the client has. So, I mean, you could be looking at anywhere between 40 and even 50% at one point if they're making a huge profit on the property. Obviously, one of the best ways to do this is one of the videos that my buddy Steve had put out, Stephen Colon, that talks about doing a 1031 exchange. The challenge with that is, like I said before, with most Latino clients, is that they want their money. So where you're able to make any modifications or any adjustments on the amount of profit is with the home improvements. So that's why I said don't worry about so much if you have all the proof of the receipts and everything. You only need that stuff if you get audited. If there's no audit, there's no need to have to declare what, whether or not we have those receipts. Don't worry about that stuff. But one thing to keep in mind is that you should absolutely report the sale on the tax return. See, the title company, in some cases even the attorneys, are required to submit a 1099-S like in SAM to the IRS. And usually what happens is the client files a tax return, they feel like they didn't get caught, and 2 years later, after they spent all the money, that's when they get the bill from the IRS saying, hey, by the way, we got this 1099-S that was submitted to us, and you need to file the tax return. So make sure that the client is aware that they will have to file a tax return. If you have any questions, give us a buzz, 917-698-0551. Send us an email, like and subscribe. The email is alexruizrvp@gmail.com. Thanks. God bless. Be safe.